Okay, welcome everyone to the Orderflows Inner Circle Weekly Webinar number 14, the Flip, Part 1. Now, this is Part 1. There will be probably at least 2 other parts over the next couple of weeks. I am still waiting to get back the final version of the indicator from my programmer. It's a different programmer than I've dealt with in the past, but he's a good programmer. He's actually programmed for some other order flow software on the market, and it just takes a while, unfortunately. Sometimes you got to make changes, and it's a lot of going back and forth between me and the programmer. And the programmers, seems like most of the programmers for NinjaTrader scripts are based in Eastern Europe, and they're on different time, obviously different time zones, and English is not their first language. But anyway, in the meantime, I'm going to talk about the flip, sort of some of the theory that goes behind it, and some of the stories, about the market, and sort of how we developed the flip. So, if I don't know how long most of you guys have been involved in the markets, but if you go back 15 years, what year are we? 2016, about 15 years, maybe about 18 years, there was a Eurex trader named Paul Rotter, and his nickname was the Flipper. And basically what he would do is he would work huge orders in the opposite direction of the side that he really wanted to take. So say he wanted to sell, right? He would throw in big bids on big orders on the bid side to give the impression that there was demand in the market, and then the market would pop up. So when other traders would see the size in the market, they would immediately jump in front and try to take the trade in the direction of the huge order. Then he would pull his order and take the trade in the opposite direction. When I say he'd pull his order, he would be working sometimes there's different ways he can do it. He would work, say he was trying to sell, right? He'd throw in some offers above the market, and then he would throw in some big bids below the market, just to give the impression that there was demand there. And once he would get filled on his original intended order, or sometimes, he would bid up the market by, posting bids in there and getting people to push the market up. Then he would come in and start selling, but at the same time, he would cancel his bids. And, really all he would try to get is a few ticks out of the market. Now, why is that relevant? Well, his size was in the thousands, and, I'll say in his prime, but, in the times that he was doing that back 15-20 years ago, his daily volumes were massive. There was 150,000 lots days, 200,000 lot days. He could be as much as 10% of the daily volume in the market. So when you think he's just trying to get a few ticks, yeah, but if he's trying to get a few ticks, 3 ticks on 2,500 lots is 7,500 ticks, right? At 10 euros a tick, that's 75,000 euros. And if imagine he's trading 180,000 lots a day, okay? Imagine how many lots, imagine how much profit potential he's got if just a big, not say a big portion, but a portion of his trades were profitable. So that's how he became famous. And actually he flew under the radar for many years, and there's a lot of traders in Europe that are very still angry at him. I think now he's living in Singapore. He's got his Rotter investment company. But that's how he got started. And he started trading on his own. He used to work for a bank, Daiwa, I think it was. And then he left to start up his own fund. With just like $1 million under management, and they're profitable basically from the first day. So that was over 15 years ago that he was doing that, and that was at the time when electronic trading was really taking hold in Europe. Eurex was electronic trading from basically I think it used to be the DTB, the Deutsche Terminal Börse, or whatever, DTB, and then eventually morphed into Eurex. But the main thing was, that's how, that was basically the death of the life exchange in Europe, in the UK, was DTB, was trading electronically, and there was a holiday in London, and bunds were traded on both Eurex and Life. At the time, Life was the most dominant contract as far as the bunds went. And but the market was closed, but the electronic market was open, so people started trading the bund on the DTV. And eventually all the volume moved over there, and people saw those electronic, I said that was at the time where electronic trading was really starting to take off. And it just sort of grew from there. That was the big change in Europe. And in Europe, it really, all the exchanges really went electronic pretty quick. In Paris, you're just talking months. I was not say months, but once the exchange, the bourse, Paris bourse, said their contract was up for renewal, they didn't renew it, and then they just said that we're just going all electronic. So back in 15, 20 years ago, things that are illegal now, spoofing, it wasn't illegal back in the days 20 years ago, 15 years ago, when electronic trading was still relatively young. So what he would do, and it's not like he would just go in and spoof the market, work big bids and big offers all day long. No, he would look for areas that he can pull it. I'll say pull it, but look for areas either on a chart or in the order book that he can lean on and get away with it. So if it was near a technical area, he could do it. If it was in a place where the book was at that time, maybe he could get a few ticks out of it, he would do it. Not every time was successful. There's times he lost money. And so fast forward to 10 years from the time of Paul Rotter, and there's this guy Navinder Sarao. And if you remember, in 2010 there was the flash crash when there was a massive E-mini S&P order hit the market. I forgot how many, 160,000 lots, and it basically caused the flash crash. There just wasn't any liquidity. Now this poor guy Navinder, he's based in London, and he's trading for a prop shop. He trades through a prop shop. He had different accounts out there on the street. But over the years, he had been basically spoofing the market. What he'd do is work bids, work offers, pull them, do all that spoofing stuff, which I'll get into in a minute. And he was charged for it. He was charged for causing the flash crash for his spoofing. And basically, he gave the impression that there was liquidity in the market when when technically he didn't have intention on following through on the I don't want to say following through on the trades, but it was just giving the market the impression that there was supply demand when there really wasn't. So the U.S. government charged him, and they're waiting an extradition. I don't know where it is at this point. I don't know if they've extradited him to the U.S. or not, or he's still hiding out in the U.K. But according to reports, over a 4-year period, he generated $40 million in trading profits. Now, spoofing is just basic market manipulation. And so what is spoofing? It's the act of, this is from the CFTC, the act of submitting or canceling multiple bids or offers to create a misleading appearance of market depth with the intent to create artificial price movements upwards or downwards. So, even though it's illegal now, it's against the law, it's hard to prove, and I do think it still happens today in some form. Now, when I say it's hard to prove, because then you have to provide a lot of evidence that I won't say can be manufactured or not, but it's one of those things. People could. It depends on how you're doing it, right? Traders are generally very high in integrity. At least they used to be when I was on the trading floor, on the CME, right? When you're dealing with traders on the trading floor, and you're doing trading via hand signals, that's you have to have the highest integrity, because when you do a trade, you have to honor. You can't come back and say, no, I didn't do that trade. If you did that, no one would ever trade with you again. And now, with electronic trading, people, it's sort of a different mindset of traders. They sort of come in there thinking they're trying to get an edge any way they can. So they may not understand that spoofing is really, illegal. Every once in a while I read these stories about, some kid at, some university who's running all these tests on his computer, back tested and everything, and he thinks he solved the markets, but in the end, he blows up, because part of what his trading revolves around is, he's got to prop up the market. There has to be the supply and demand in there that just isn't there. So, it's hard to prove, but, it does get proven. There is a case pretty recently. A guy got fined, I think, a couple $1 million, and I don't know if he went to jail or not, but he's banned from trading for, I think, at least a year. I mean, I don't think that's harsh enough, but it does happen, and people sometimes they just don't understand that there is a law against it. Even though you got to sign papers that say you won't do it when you start trading. I don't think most people actually go through and read all the paperwork. And actually the firms, right, the FCMs, they will cooperate with the government and the exchange on if they ask for information, because what a trading firm, what an FCM has to lose is they have their membership to lose with the exchange. If the exchange wants to fine them, it's the firm that's going to take the fine. Maybe the individual trader can't afford the fine, because it could be in the hundreds of thousands or millions even, and firms don't want to mess around with that. The profit margins are razor thin nowadays, and it's just something that's hard. But sometimes people think that they're going to pull fast ones. Usually you read about these, if you've ever had an interest in reading about these great trading scams, and that's what they revolve around, is spoofing, pumping and dumping, basically. Basically talking the market up, and then selling it, and then let the market drop, right? I mean, whether it's penny stocks or whether it's cattle futures or whatever, it's against the law. And that's why I'm not a big believer in DOM-based trading strategy. DOM is the order book. When you see orders going in on the offers above the market or on the bid below the market, you're supposed to do something. I don't like that. That's not trading. Basically you're trading off someone's intent to do something. I'd rather trade off of actual traded prices, traded volume, rather than someone's intention of the market. So, what did Paul Rodder do? Was that spoofing? Personally, I think it borders on spoofing. At that time there was a lot of gray area. It wasn't really looked down upon. Now, back on the days when there was a trading floor, it's I don't say it happened, but when traders were stuck on a position, right? So a big trader. I'm not talking about a big bank or anything like that. I'm talking about a big local. So say he was long, 2,000 bonds. Tom Baldwin, perfect example. Say he was long 2,000 bonds and he can't get out, and the market's going down. He sort of has to. He's got to get out, but he can't just get out at the market. So he's sort of got to, the market's going against him. He's got to somehow give the intention to the market that, one, everybody on the floor knows what he's doing, but the people off the floor don't know what he's doing. So, so for example, right, you're a trader and you're long 2,000 bonds at 21, and it starts to move against you. It starts selling off. You're long. Let me tell you what. I better pull in a document. Oops. We'll just sort of go through it real quick here. Okay, so you're long 2,000 bonds. So small. This is bigger here. You're long, and it's still not that big. So you're long 2,000 bonds at 21. Okay, market starts going down. Market starts dropping, trading 15. Trading 15 now. Okay, we sort of stop at 15. Well, you're long 2,000 bonds at 21, and it's trading at 15. It's against you right now. You need to get out. So what do you do? Okay, do you start selling the 15s? No. What you would do is what locals would do is they would start bidding. They would start bidding 14. Trying buying the 14s, bid it up to 15. Bid it up to 16. Maybe they get at some at 17 or 18. And then on this, they start bidding in here 14, 15. Hoping it could start trading 16. People that are outside, in the banks just, at this time, they're just, bank traders are trading on they're trading via squawk box. They hear the floor. Okay, hey, so-and-so got long at 21. Then all of a sudden, next thing we're trading 15. Okay, then the market sort of stops here at 14. And then a bid starts coming in, so people start reporting back. It's 14, 15, 15, 16. And these banks start coming in, and also they start buying it. So, the guy that was long and wrong at 21, he could now, these bids coming in at, 17, at 18, he could start, cutting his position. So, it'd be like, in a football term, right? So American football, if, you turn a 5-yard loss into a 2-yard loss, it's still a loss. But, he's now, by bidding up the market, he's able to get out of his position at a slightly worse, better, worse price. So instead of getting out at 15, he's able to get out at 16, 17, and 18. So he's got a better average price rather than getting out at 21. Okay, so why does spoofing work? Well, you go back to the law of supply and demand. When something is in demand and supply is lower than the demand, price is going to go up. When there's more supply than demand, price will go down, right? I mean, that's just basic economics 101. I talk about economics 101, but it's the law of supply and demand. It's not the theory of supply and demand. So if there's a lot of demand, but there's very little supply, price is going to go up. And if there's more supply than demand, price will go down. So, if you have an order book and you start stuffing orders, layering them on the offers, making it look like there's a lot of supply in the market, that impression will drive the price lower. People will see that and say, hey, there's a lot of sellers here. The market will go lower. Just as, if there's, people start putting bids in the market, big bids, to give the impression that there's more demand, people will see that, especially if you're a seller, you see, hey, I'm trying to sell it at 16, but I see at 15 now there's 1,000 lots, someone's trying to buy at 14, there's another 1,000. Maybe I could pull my offer, and instead of selling it at 16, I could sell it at 17 or 18. People will back off. So, let's take a look here. Okay, we'll just sort of go through how this spoofing and flipping in the order book works. Okay, so you choose a direction. Right now the market's 50 bid at 51. It's 50, 51, 50 on the bid, 50 on the offer. You want to buy it at 49. Okay, well, you're below the market. Okay, so what you do is, you work your bid. You put in, the bid 49 for 10 lots. So, the size has moved from, it was 50 before, now it's 60. Okay, so you're still behind the market. Then, so what are you going to do? You're going to spoof the market. So you're going to show size on the offer. Now, this is just a basic, elementary example. There's a lot more trickier ways to do it. But, just for basic understanding, I want you guys to understand how spoofing works and, why it's illegal. I'm not saying to do it. I mean, most people aren't going to do it. Basically, it comes down to, with the market, if you have to ask, if you find yourself asking yourself, is this legal? That's usually a good sign that it's not legal. And I've faced that several occasions working in the bank. You got to ask yourself, it's just the basic common sense test. If you have to ask yourself, is this legal? Chances are it's not legal. And spoofing is definitely not something I condone, but you should understand how it works. Because I do think it happens on a certain extent, on a smaller scale, but I do think it still happens. And so what you're going to do, okay, so I left my, there's a 50, this should say 60 here, it says 50. But so what you do is you throw in an offer here at 51 for 1,000 lots. So you're going to give the impression that there's a lot of a lot of size here at 51. A lot of supply there. I better change that. Okay, so not to confuse you, I changed it to make it a 6. It is like my report card in high school. You changed a B to an A. But it's 60 lots on the bid, right? You're trying to buy here at 49. So what you do, you throw in an offer here at 51 to give the impression that there's a lot of supply in the market. So what traders will see now on their order book will say, hey, there's a big seller up here. There's supply in the market. And they're going to react off of this, even though I have no intention of trading here at 51. I really want to buy the 49s. I throw in a big offer to give the impression that there's supply in the market. So what happens? The 50s trade out. Before it was 50 bid, everyone sees this big offer at 51, sell the 50s, and next thing you know, it's 50 offered. Okay, it's 49 bid at 50 now. Okay, that's the whole point of spoofing the market, is to give the market the impression that there's a lot of supply here. All these people that like to trade on domes, they say, hey, 1,000 lots here, and they start selling the 50s. That's exactly what they do. If they see the size coming in here, and they think, I got to get in front of it, I got to step in front of it, and so they sell the 50s and starts the 50s they bid at, and they start selling the 49 bid. Okay, so it gets down here where it's offered, all of a sudden now it's offered at 50. How often have you seen that? If you've ever watched a dome, you see that happening all the time. Okay, so you're there, and go back here. Now the market's 49 bid at 50. There's 60 on the bid, 25 on the offer, and you're sitting here at 49. You're waiting for it to start trading. You still have your offer in there. There's people are still coming in and saying, hey, the market's going to go lower because maybe this guy will move his offer down and start taking it out. I better start selling 49s. So the next thing you know is the 49s trade goes 49 offered. So you're filled. You bought your 49s. Okay, great. That's what you wanted to do. So what do you do now? Well, you pull your offer. You pull your 1,000 lots at 51. Okay, the market's still 48, 49. 50 by 25. However, what happens is the market will seek its equilibrium back, and people will say, okay, well, the offer's gone at 51, and it moves back to this value of trading 50, 51. Okay, and you bought 49s. That was your goal. Now the next part is what happens next is the market's going to generally pop back up. It will go 51, 52. Why? It was before. It was 50, 51, but someone came in here and spoofed the market, right? It gave the impression that there was a lot of offers here at 51. So the 50s traded, the 49s traded. So all these people that sold down here, these locals that thought there was new supply coming into the market, they're short. Okay, well, they don't want to be short because that supply is gone now. And so what they do is they got to cover it back. If they can cover it at 50, if they're short at 50, then great. If you're short at 49, you can't buy back the 49s anymore. Because all of a sudden we're back to 50, 51. So the people that are short at 49, they got to try to buy it back at 50, at 51 in here. That's to me, that's what that's the whole definition of trap traders. People that are in a position that are wrong. You watch these videos, people talk about trap traders happening at the ends of bars with heavy volume. No, it could happen anywhere. And generally trap traders are these locals that are wrong, or someone stuck in a position. Doesn't necessarily happen at the extreme of a bar. So if you got short in here at 49 or at 50 because of this fake order in here, this spoof, then once that's gone, right? Because you're getting short, thinking that there's supply in the market when there's not. Right? Someone just came in there and did that to trick you. So, you sold 49s, maybe you sold some 50s, and all of a sudden the supply is gone. You don't have this offer to lean on anymore, so you got to cover it back. Because, how often have Have you seen, size come in, the market push lower, that gets pulled, all of a sudden, next thing you know, you're trading 54, 55. That's why I say it still happens to a certain extent, maybe not on the extent of, the flipper or Navinder, but I do think it still happens. Okay, so why does spoofing work? Well, there's a couple of reasons, right? The example I showed above, I showed a supply side spoof. Other sellers are tricked into lowering their prices, because not only, are people selling the bids, but, other sellers are also lowering their prices as well because they think the price is going to go lower. So imagine, you're trying to sell here at 50, 51, right? And then all of a sudden there were 50 offered, 49 offered. There's a big offer there. If you're trying to sell it up here at 52, 53, you're thinking, oh God, I'm never going to get filled. And you need to sell this. All of a sudden, the next thing you know, you're lowering your offer down to 50 or 49. Again, that's a form of market manipulation. So, because you're tricking other sellers into lowering the prices or even hitting the bid, people that got to sell it, they got to get out. And you're given the perception of additional supply. Also, on the other side, buyers are pulling their bids. So, say you're back here, or even back here, all right? It's 51. It's 50 bid at 51 right now. It's 50 on the bid, 1,000 on the offer, and you're trying to buy 50s. Well, when it was just 50 on the offer there against 50 on the bid, yeah, okay, fair enough. If you can get it, great. But you know what? If you're bidding 50, if you're sitting here on the bid and there's someone comes in and offers 1,000, you're gonna cancel your bid. You're gonna back off. Generally, you can, unless you really want to get filled, because you're gonna think that people are gonna come in and start hitting this bid, especially if there's this supply. If you get one or two other people coming in with supply, next thing you know, in theory, if it's real, we should be trading 49, 48 and going lower. So you're gonna back off your bid. If you're one of these algos, now they have these algos. They measure the size and do all these things. When big order comes in like that. If there's a one of these algos, they'll see that, and instead of bidding 50, they'll go down to 49 or 48. They're not going to sit there right in front of a freight train, because if this seller comes in with another order right here, boom, it'll be offered there, offered at 49, offered at 48, and just go lower. So so you got two things going in effect. You got buyers and sellers that are being affected, not just one trader on one side of the market. Buyers and sellers. That's what they tried to pin the flash crash on the guy for. The big legitimate orders came into the market to sell. It was a hedge fund out of central part of the United States. I forgot where. And as I said, it was a big order, 160,000. And it's just going through. The execution algo thought there was bids in the market when there really wasn't actual bids. So this order would go in and start trying to hit these bids, and then they'd be pulled, and just keep hitting it. And next thing you know, we're down 1,000 points in the Dow. So there's what I just showed you is a basic spoofing, how that works. Now there's other techniques, which is layering, which is also what the guy did, the Navinder Singh did, is, layering would be, you work bids, you just stack them in here, 500, 500, 500, 500, 500. Then as you get there, you just start pulling them, but really you're just trying to give the impression that there's a lot of support in the market, or a lot of resistance in the market, or, a lot of demand or a lot of supply. And, that's illegal too. And it's called layering. And basically you're stacking the order book with a series of bids or offers on one side of the market and canceling them, as you get close. Now, when I was at JP Morgan, sort of a side story, we did get a call one day from the exchange, Osaka exchange, and what we had a client actually that had direct market access. So basically they were using our JP Morgan connection to place their orders, route their orders, which banks do. They, for customers, they give them direct market access. And what they were doing, this was happening in the Nikkei, is they were entering orders literally every tick, for a few hundred, 500 at least. And because the Nikkei, on Osaka, the bid offer is very liquid. It's very, you had a couple thousand, 500 to 1,000 on the bid at every level. So what they would do is they would enter them as soon as the order entry period opened on the exchange, and they were entering, massive amounts. Basically, they were trying to get queue position. And I know a lot of guys on Life that used to do it when first went electronic. You want to get queue position, so when the market is here it's 51, 52. If you're in front, because these exchanges is first in, first out. So if you're in front, you have an edge, right? Because it's first in, first out. So if you're front in the line when it's 51 and 52, lots of times you're going to, especially a market that's very liquid, like the Nikkei, where you got a couple thousand on the bid or offer, and you're in front, then that's great at every price level because you have a chance to buy the bid and then sell the offer, when it comes back up. So lots of times, sometimes they'll trade 5 lots here on the bid, and then they'll trade, back up here on the offer, go bid again at 52. And you could make a good living doing that. That's what locals on the floor used to have the edge. That was their edge. Basically, they were the bid and they were the offer. But exchanges frown on that because it clogs up their pipes, so to speak. Especially with a lot of, because every time an order goes in, it's got to come back with an order number, ticket number, and for whatever reason the exchange didn't like it, and they threatened to cut off our access because of this one customer. So we had to tell the customer. It was a bank in Singapore that didn't have membership with Osaka, but they came through us. They were a customer of ours, of the bank, so we gave them access. But we had to cut them off, or tell them they can't do that, otherwise we'll cut them off, because the exchange threatened to cut us off. So that's why I say, these people that do these activities, they don't understand the repercussions. It just doesn't affect them; it affects the whole chain. So, in the stock market, they call it pumping and dumping. Okay, penny stocks especially. People talk up stock, pump it up, get the price high, then they sell it. Okay. Maybe they were long earlier, or they'll just buy it back when the price crashes. And the guys that do the spoofing, they'll generally try and pawn it off. They're not, unfortunately, they're not stupid. They think they have an edge this way. And when I say not stupid, they've got advanced mathematical degrees. Maybe they're a few courses short of getting a PhD, but they'll come back and say, well, statistical modeling or analytics, or relative value, or something fancy that people say, shake their head and go, okay. But at the end of the day, it's market manipulation. Well, yeah, I could do statistical modeling that shows that if I stack the order book in my favor, then I'll make money. But it's not. It's basically basic pumping and dumping, market manipulation. So why is it illegal? Well, traders are tricked into doing something based on an order that was never intended to be traded. CME actually has a new rule. It's Rule 575. CME owns CBOT, NYMEX, and COMEX. And basically it says, it does say, no trader, no person shall enter or cause to be entered in order with the intent at the time of order entry to cancel the order before execution or modify the order to avoid execution. An actionable or non-actionable message with the intent to mislead other market participants. An actionable or non-actionable message with the intent to overload, delay, or disrupt the systems of the exchange or other market participants, or basically disrupt trading. The fair execution of transactions, and that's sending tons of orders in with, basically to clog up the pipes. That's what the exchanges don't want. So, but the important parts are the first two. An order with the intent at the time of order entry to cancel the order before it's filled, or modify the order to avoid execution, means, you move off the price. So instead of selling at 51, you move it up to 55, because they have to put that in there, because, you're going to get these smart asses, they're going to, put the order in here at 51, okay, 1,000 at 51. And then all of a sudden we come up here, they back up to 54, because it's cancel if close, like that. Then that's what the exchange, they don't want. They want people to put in orders with the expectation that they're going to trade it. Now, these guys, their defense is, well, if we trade there, then I'd have a position on. Well, they're putting it in there not with the intent to trade. They put it in there with the intent to give the impression that there's something in the market that's not there. Okay, so to be honest, most of us are not going to do spoofing. Our accounts, for one, most people's accounts aren't big enough. You probably need accounts in the millions. There are stories about people doing spoofing manually, not using a computer to do it. There's a guy, I think, had some traders in China entering orders in, manually. They were assigned to do certain things that would make it look like it was actually being done by different traders rather than one person. Now, there are a lot of gurus out there that talk about spoofing being done by the big banks and whatnot. But actually, they're wrong. It tends to be done by independent traders. Banks can't do it and generally won't do it. As I said, penalties are severe. The bank can lose their, I'll say, trading license, but their memberships at the exchange. The exchange will penalize them. The death blow would be take away their trading rights, which generally hasn't happened. They get warnings, repeated warnings, and the traders will get pinged. The individual trader that's doing it will get pinged. I think there was a case or two at JP Morgan where some guy was trying to do it. But you see all these stories, people trying to manipulate the markets, and banks are getting fined for hundreds of millions of dollars. It's just not worth it to a bank. And generally, for most firms, most banks, they have an order. The order has to be executed, and the person that's executing it, as far as the execution desk, the person has to execute it as is. They can't just start trading around it to try and manipulate the market. I'll get into that in a second. So, well, again, going back to this last part, gurus talk about spoofing. That's banks do it all the time. They don't. Banks are generally very strict on their trading activity, especially now. Maybe in the past, there were people that did it in banks, but honestly, I spent over 10 years at banks, and honestly, I've never met somebody that did that as their form of trading. What you have to realize, markets are attracted to size. That's something I learned very early in my career, fortunately. And once I understood that, then I understood that if you have to move size, right, you can only trade against size. Trying to move size in an illiquid market is going to chop you up and in the end kill you. So legitimate traders, right, actual traders, people that have size to move, they need to trade it against size, right? They're not going to sit there and play in the order book, right? If they see a size offer, they need to get long, they buy it. No questions asked. If they need to sell, they sell it, period. I've seen guys get a quote from the market. Hey, what's what's in there? Say bonds, okay? Say bonds. What's in there? It's 6-7, 200 by 200 by 500. Okay, then if the guy on the phone was any good on the floor, it would say, but there's paper below. Say it's market 6-7. There's paper below at 5 for 500. Okay, hey, sell 500 down to 5. Because they know there's size there. They'll just go in and get it. Actual trades are commitments. When someone's in a trade, they're committed to the market, right? But if someone's just flashing orders in the order book, that's just intent. They're not filled. So they don't, whoever's flashing that order, they're not committed to the market or to that position, right? They're just, I don't want to say playing games, but they're at any time they can change it, right? And they can change their mind. But once you're in a trade, you have to trade it, right? If you're just putting orders in and out of the order book, you're not actually trading. And that's why I always say intent and commitments are two different things. And it sort of goes back to sort of relationships, right? Say there's a girl you want to ask out, and you sit there. You either do it or you don't. You could sit there and talk about all the things that you want to do. You want to go take her to the movie, take her out for dinner. Well, it doesn't matter until you ask her out. And it's just like trading, right? It doesn't matter until you get into the trade, what you're going to do when you have a commitment into the market. So, what does that mean about the flip? Well, the flip, again, it's not ready yet. I'm going to follow up after I'm done with this presentation. But, the flip is going to find those areas where it's actually done traded, not intent of the market, where, it comes up. And then you see, these times where you just see like this, right? All buying, all of a sudden it's changed to all selling. I mean, it's not as, this is just a 1-minute crude chart from this morning, but, it did pop up and then, just on all buying and then turn around and go down on basically all selling. So, the Delta Scalper, which I've released, that does detect shifts in supply and demand. However, there's a difference. It looks for turning points in the market where you're having shifts in supply and demand. The flip is different because it can happen basically anywhere. It can occur in the middle of a move. Sometimes moves just stop like that. Or it could happen in an area where, I'll say a congestion, but in an area where you're sort of like a snake shape, dragon shape going up and down, without real direction. But it's similar to spoofing. It doesn't pick up spoofing because it doesn't look at the dome, but rather it deals with the real trading, what actually traded, not orders going in or out of the order book. So it takes it a step further. These spoofers, they are exposed to execution risk. So, let's say you work 1,000 on the offer, someone could buy it from you and you're screwed. Okay, so, the flip actually deals with actual trading, not spoofing in the market. Sort of the theories are, similar, but, imagine spoofing, but actually traded. Okay, I don't know if that makes sense. But what is happening in the market, right, is new supply or new demand coming out of nowhere. That's where the flip can occur. Now, I'll show you some examples in a bit, but before I get to that point, talk about sort of the different execution desks, the different trading desks that are out there. Okay, so banks have execution desks for client orders and house orders. House orders, a trader at the bank has to trade. Maybe he doesn't have a system, he gives it to the execution desk. Client orders, banks execute orders for all the big hedge funds, for all the big pension funds. It's going to go through the execution desk. These people have to execute the order as is. They can't start saying, I got 2,000 mini S&Ps to sell. First I'm going to buy a couple hundred to sort of bid it up and then sell it. They can't do that. Okay, that's an extra order. Then they got to write up all sorts of paperwork because they got to explain why that order happened. And if you do that a lot, you're going to get in trouble. You can't do it. And there's no purpose for them to do that. They're just going to get the order, execute it, report the fill back. Now banks. Let me get to the third one here. They have small prop desks now. The landscape has changed a lot with a lot of these banking rules. Banks have really had to cut down their prop desks. So back 30 years ago, even 20 years ago, banks had a lot of prop traders. Basically betting the bank money. But obviously after the financial crisis, that was the big thing. Banks had to cut that back when they got the government funding. So what they've done is they've sort of restructured it, and they call it Delta 1 desks, which technically is supposed to hedge position done in swaps. That's on a basic level, or ETFs. So, if they do a swap deal, or if a swap move, the reason it's called Delta 1 is because, think of it in the terms of an option, right? Option delta, say it's a delta of 1, for a 1 point move in an option, the future should move 1 point. So, when you're trading, swaps and you have a hedge, the swap moves in, the price moves in one direction, you have to hedge it in the opposite direction. And, swaps are actually a big money maker for banks because they can mark it up. And it's just a form for them to do prop trading without them doing prop trading, in a sense. I can get into that in another presentation, but I just say it's a big money maker for banks. A good swaps trader can make a bank millions of dollars. and the trader himself can make 7 figures. Commodity firms generally have now all of the above, although they may be a little bit bigger on prop desks because they can do prop trading. But commodity firms can do hedging, with a kind of a similar Delta 1 desk, and obviously they have execution desks, because they do get orders for clients that they need to execute, for hedges, so commodity firms do have customers that they hedge for. Prop firms just have prop desks, people trading proprietary positions. Okay, so now you understand, there's these different desks, so really the only area that you're going to get, the market manipulation is this area here, the prop firms. You're not going to get it with commodity firms. Generally, their traders are, they've got information that nobody has. They don't need to manipulate the market, Commodity firms, they know how tall the corn is. They know how many, whether it's silking properly. They know the weather, in Malaysia, how that's going to affect, the transportation of the produce. And they know all this information that general traders don't have. I did leave out hedge funds, but that sort of comes under commodity firms. Like I could do commodity firms / hedge funds. They sort of fall under the same thing. Hedge funds do have a bit of leeway as well because they exist to make money. But banks basically have 3 types of desks: very small prop desks, now very, very small prop trading desks. The big money makers now are what they call these Delta 1 desks, which they sort of threw in the prop trading in under the Delta 1 desks. And they have execution desks, but again they don't make big money on execution. There's a lot of risk, but they don't make a lot of money. Nowadays execution rates are so small. So what's going to cause the flip to occur? Well, let's just say you can only control the things you see happening in the market and react to it. Okay, you cannot control what is about to happen. You don't know when a trader at Barclays or JP Morgan is going to get a big order, sell 5,000 E-minis. You have to pick up signs that it's occurring, right? You saw these big things here, so you don't know, right, if a commodity firm or a bank, you don't know if they did a deal in the cash market and they're going to come to the futures to hedge it. You don't know that, okay? So you don't know when there's going to be that order, but you have to be able to pick it up in the order flow, in the delta. So, why is it important? Well, obviously when a huge order hits the market in the opposing direction of a strong move, then it's important. So anytime you have a change in market direction, it's important. It could be the beginning of a new trend, obviously the end of an old trend. So let's look at examples here. I talked a lot about theory. Let's sort of look at some of these examples real quick. Again, this is just last week here. I just pulled up a few charts, sort of where it's happening. You can see, this move down from this high. Why did it move down? Well, you're moving up. You got this negative delta up here, but it's it's changing, right? You strong buying, all positive delta early. All of a sudden it changes. You got negative delta. That's not a good sign. That's the first sign that, hey, something's amiss. You do have some support here, right? I've talked about this, where you're moving up, right? But you got bids in here. You got the negative delta, and you're still moving up. Well, what happens? You get up to the high, and everything just falls. The wheels fall off. Very strong buying up here on the high. Positive max delta, 1334, and it ends up at minus 57, right on the high. And look, then you just, boom, you sell off from 165, even 164.24. Again, this is the bonds. You're coming up, you hit the low, start rallying, right? You got this bar here, very strong positive delta, 405, max delta is 498, min delta 0, and it just turns right on you really quick, right? You'd be expecting the market to be rallying right off this low, off this strong delta, or not, well, it's not strong, you have a divergence, 88, 103, 405, that's the delta surge, right? Well, almost the delta surge kicking off. And then it's just wham, it just gets slammed again, minus 1100, and then it just sells off again. You're talking 162.13 down to 162.03. Okay, so it's not just as simple as this. 0 and 0, you know, 0 min delta followed by 0 max delta, then make the move. There's a little bit more to it. You know, because, you know, this is an example right here. You got 0 max delta, and then 0 min delta, you know, which would indicate, you know, you should see some buying, but, you know, it didn't follow through in this one, and you made a new low. So it's not as simple as that. You know, here's another example. This is sort of E-mini 5 range chart. This one just sort of went sideways, actually. You know, to me, this would have been a short. Or, yeah, I don't know, this one's kind of iffy here. You know, it sort of was going back and forth. You know, you can see it, you know, it's sort of going, you know, this started giving a bullish sign, then a bearish sign, and in the end, it just went sideways. It's not the greatest example, but I have a feeling it, you know, it's close to it. You know, you can see it here. You can see strong selling, and then strong buying, and then strong selling. You know, usually when you get 3, you know, sort of opposite signals, that's not a good sign. You know, it ended up on the strong selling, then sort of came back again. You know, some decent buying, but, you know, realistically, it's, you know, this probably isn't the greatest example. Now that I look back on it, but, you know, here's another example. This is Euro stocks. It's a bit older chart. You got a lot of things happening in here that you should have gone higher. You know, you got the strong selling, then the strong buying, you know, decent buying, but it just sort of hung around the low. Actually, I would have expected a little bit more. This is a little bit better. You know, we hit this low here, and then we start, you know, seeing the signs of, you know, changing from the supply-driven market to the demand-driven market, and, you know, you make a decent little pop up there. Here's a better example. In here, this area in here, you sort of have it showing up a little bit earlier, but, you know, say you missed it in this area, it's showing here again. You know, you can sort of see it on the delta. You know, it's quite interesting on this bar. You do have this low, 8,000 lots traded, and you got a delta of 7, which is nothing. You know, it's the difference of 1 trade. But, you know, it's giving signs that the buying wheel is turning into a demand-driven market in here. You can see some imbalances on this way up. That still makes them move down, and then again, you still sort of, you can see the same sort of things here building up now in the delta as you start moving higher. So, you know, that's it. You know, I'm going to chase up the programmer again today. Maybe he sent it out to me. I haven't checked my email for a couple hours. But I do hope he gets it out to me in the next day or so. Then I can get it out to you. Like, I finish up the user manual for it and get it out to you guys, preferably before the end of the week. I do want to get it out as soon as possible. I'm excited to get it as well. So, you know, if you know, Paul Rotter, he's got this Rotter Invest asset management. You know, he's got these rules on his website. You just go to Rotter Invest. Yeah, but it's actually, I was looking at it. I just happened to search it on the web. But, you know, these are his trading rules. Be true to yourself. Wait for the right opportunities. You know, skills, precision, maintain control, interpret the signs. Don't count on chance. Have confidence and nerve. Successful investing requires skill and experience, not luck or magic, and it's contact. But, you know, these rules here are actually very, very true. You know, so it's, you know, he's still around. I don't know if he's still trading in that form or not. You know, he's living in Singapore now. I left Singapore, gosh, 4 years ago, 3 years ago, and you know, it's just one of those things. You know, Singapore attracts the rich and, you know, the rich, because they got very low taxes. They're 15% max, and no capital gains tax. So, you know, it's a great place to go to retire. But it's just getting a little bit expensive to live there. But you know, people always ask me. People ask me, you know, where's a great place to live if you're a trader? Well, Singapore is a great place. So it's got no capital gains tax. It's got a personal income tax of you know, 15%. It's just that now property prices, since it's such a small location, property prices are out of sight. You know, you're talking a 3-bedroom apartment. Look to pay for $500,000 for that. Forget about buying a house and lot unless you got you know, $5 million minimum, and that's for a small place sort of outside the city. But it said it's a great place to go and live and trade because the time zone. If you want to trade Europe, you can. It starts in the afternoon, and you can trade the U.S. until 2 in the morning, basically. And the food is good, and quality of life is generally pretty nice. People are nice there, speak English. So, again, I'm getting, as soon as I get that copy of the indicator, email it out to you guys, and I just need to finish the instruction manual for it also to get it out for you guys. But it's hopefully this week. I gotta chase up to this programmer. He came back to me last week with a couple of questions that I had hoped he would resolve it and get it done for me. But literally, I'm just expecting it any day now. So this is the part one. Just sort of give you a base of maybe an idea of how the market works that you never maybe never thought of or didn't know, and a little bit of sort of market knowledge that you can use in case if you do trade on a dome. I know a lot of people have the Jigsaw dome. I even have a copy of the Jigsaw dome. I don't use it, but I've traded on a dome a lot of years that even though I look at the dome now, I still get excited. I see big orders coming in. I also want to jump in front of them, but sometimes you don't know if it's a real order or if it's a spoof order. Again, spoofing is not as prevalent as it probably used to be, but I do think it happens on maybe a smaller level that people try to disguise. The guy that they caught, the guy that got charged with it and had to pay the fine. He wasn't doing it for big size. He was doing it in the currencies. And he was just trying to buy 15 lots, 18 lots, 20 lots, and his spoofing orders, he was doing spoofing and layering in the order book. It would just be for 40, 50, 60 lots. So that's why I say I do think it still happens, but people are trying to sort of circumvent and sort of come up with these quote algos. To me, that's the biggest crock out there. People say, "What's an algo?" People just sort of lump algos into everything when things aren't necessarily algos. I've seen people lump in some of my ideas and calling them order flow algos when they're really not. But anyway, I'm going to hope to get another presentation out midweek as well on something else. But I said when I get the indicator, hopefully in the next couple days, I'll get it out to you guys as soon as I get my hands on it. And I do run it. I want to run a day of testing to make sure it runs properly. But in the next presentation next week, I'll talk about more on the flip, and hopefully I could really sit down and get some good examples for you guys with the indicator. I think it'll look much better. So again, thanks for watching. And again, I apologize for not having the indicator out today. That was my goal, actually. I wanted to get it out before the end of October, but it unfortunately may just come out in the first week of November. But I've actually got 2 others in development as well. So once you get give you a chance to work the flip into your trading style, then you can work the next 2 in there as well. So hopefully I get the next 2 also before Christmas, because I'll probably be taking off. I usually take off the last 2 weeks of December, so I hope to get everything done by December. So thanks for watching this, and look for my email this week. Hopefully when I get the indicator done, I can get it out to you guys. So thanks, and bye bye.